Thank you, everyone, for coming today, and then thank you, my wonderful panelists, to come as well. So, for the first panel of the day, we have a very interesting topic, in my opinion, because so over the last few years, the crypto adoption has been increasing, and accordingly, the representation in the portfolios of the institutional investors have increased as well. But it's not that relevant today because of still some regulatory uncertainty, lack of market infrastructure, lack of track record of these investments, right? So I think today it will be very interesting, the discussion. So before starting, I will ask you to introduce yourself so that the audience knows more about you and what you're doing. Luuk, if you want to start.
Hi, my name is Luuk Strijers. I'm the Chief Commercial Officer for Deribit. We are since recently based in Dubai, or at least I am, but incorporated still in Panama. We are the biggest global crypto options platform in the world. The market share we have in this space is around 85%. Besides options, we do perpetuals and futures. So if you look at our overall business, we trade around $2 billion a day, out of which 2/3 is options. So the rest is, let's say, 10% futures and 20% perpetuals. Our business is predominantly oriented at institutions. So around 80–85% of our volumes are institutional. So that's the biggest global names in the industry, plus around 50% retail, which is unlike Binance, OKX, etc., which have millions of clients. Because of our product stack, we have a more sophisticated product, a more complex product. So our retail coverage is around thousands of clients instead of millions. So it's a bit of a more targeted offering.
Thank you. Payal?
Hi, does this work? Yeah. So Payal Shah, CME Group. So CME Group is a 200-year-old institution. We initially got into futures and options for all asset classes. So everything from ags, metals, FX, equity, and then got into the crypto space about 7 years ago. So I lead crypto products for CME as well as equities. And really within the crypto suite, we offer Bitcoin and Ether options, futures and options, again, predominantly to institutional players, but also we have an offering for what we call micro products that are aimed at retail clients as well. So we options and futures on both the standard size contract and the micro contracts as well.
Thank you.
Hi. Okay, it's working. Hi, I'm Jihane, part of Blockdaemon. We're the largest infrastructure provider in the world. We currently run around 150,000 nodes all over the world. We have entities in the US, Ireland, Singapore. We're looking to set up office also in the MENA region. I cover the sales in this region as well as Benelux. And we mainly focus, as I said, on infrastructure services, such as access to more than 40 blockchain networks, staking services. We run validators for a lot of custodians, exchanges, and we have our own wallet solution as of 1 year, yeah.
Thank you very much. And I think we are here today talking about a topic where it might change a lot from today to tomorrow. I think tomorrow is the first deadline for in the US for the approval of the 12 Bitcoin ETF request. There is another deadline on January 10th, but according to the resolution for that might change a lot the institutional adoption for digital assets, right? So we have Luuk from Deribit, Payal from CME Group, which are working a lot on crypto derivatives. So I would like to start, and derivatives is something very related with institutional adoption, like accredited investors and professional investors are adopting more about crypto derivatives. So I would like to ask you, what is different or innovative of crypto derivatives versus traditional derivatives, and how digital assets and crypto are, let's say, bringing innovation and new stuff into the derivatives markets. So maybe starting with you, Luuk.
Good question, thanks. In the end, let's say an option is an option. So overall, products are broadly comparable. I think the way they're traded and the way they're structured are different. So if you look at our setup, we trade 24/7, we're always open. We don't have like moments for batch jobs. It's like a continuous process, which is typically slightly different versus, for example, CME or essentially any traditional venue. I think the way the rules are defined is obviously different. US setups versus offshore setups like us. I think that world is merging as we speak. So I'm here to get a VARA license, the new regulator here in Dubai. So the regulatory framework and the licenses globally granted to exchanges like us is changing. So over time, I think when we started, the institutions didn't care that much about the regulatory framework. They cared about the product. They cared about liquidity, the quality of the books, volumes. They cared about access. Nowadays, after the failure of FTX, they care more about quality. So all of these volume arguments are still valid, but they care more about the regulatory framework. Are you licensed? Where are your audited financials? Show me SOC 2, show me ISO certification. So where firms like CME have all of this, which is their bread and butter, the crypto space and the offshore venues like us are moving in the same direction. If you look at setups, infrastructure is different as well. So we are, again, perhaps more like CME or Eurex. We have dedicated hardware, we have co-located clients. Clients can plug in their server next to ours, while typically crypto exchanges are cloud-based, hosted somewhere in AWS with different kinds of connectivity. The regulatory capital is different. The type of venues is different. So I think typically, if you want to trade on any exchange globally, you need to have someone providing you access. You need to have regulatory capital requirements, which means that in the end, when there's like 100 potential trading firms, we can typically onboard almost 100, and not all would qualify under the same rules on, again, let's say CME. That doesn't mean that, or that actually means, I think, that we can provide tighter spreads and books and quality simply because we have access to more. I think overall the access to end clients, retail clients, is also different. People from anywhere in the world except the restricted countries can trade on our market, while traditional markets are more regional and less accessible. So I think in the end, there's lots of tiny differences making markets different. Product-wise the same. We have inverse options. So you deposit BTC to trade the BTC option, which is kind of strange if you compare it to, let's say, Tesla options. You don't pay Tesla options in Tesla. The price is not priced in Tesla shares. It's quite of a strange product which started out in 2016 in the overall crypto space. So lots of differences, but I think in the end, because of failure of one, the push for venues focusing on institutions like us is for those markets to align more and have the same quality standards.
Thank you. Your perspectives, Payal?
Yeah, so if I could take it back a step, actually. So when we first got into the space in 2015, 2016, a lot of our clients were asking for crypto exposure. And at that time, it was a very much a spot, well, only a spot way that you could access crypto. And that didn't really fit in with some of their mandates. So if you think about spot platforms, or if you think about some of the unregulated futures platforms, those institutional clients were not able, and probably still are not able to access those markets simply because they're not regulated. So if someone wanted access to Bitcoin or Ether, their hands were a little tied. And so really that's where we came in. And the offering is very simple. It's a USD cash settled Bitcoin or Ether futures contract. And so breaking that down, what that means is you don't have to deal with wallets, you don't have to worry about hackings. So these institutions, they don't need to necessarily hold Bitcoin or Ether to get Bitcoin or Ether exposure. So it's done in a very similar way as the S&P 500. So if you want access to the S&P 500, you would take that performance against an index. So we took the same principles to crypto and created an index for Bitcoin and for Ether, as well as now 22 other coins. We only have futures and options on those two, and we'll come back to that maybe. And so the idea is that it's a cash settled, as I say. You don't have the need for a wallet or security. It's index based. So any constituent exchanges, there is certainty that there will be a price at the end of the day. If one of those exchanges goes down, the price is not affected because we take the average out of 6 exchanges. And it's regulated. So we are fully regulated by the CFTC, meaning that institutions can have some knowledge and the checks and balances that we put in place for all of our other futures is the exact same that we have for crypto. And I think that's reflected. You mentioned the ETFs. So last year, the first ETF on Bitcoin was a futures-based product, and that was by ProShares. That was the first ETF that got to $1 billion notional or assets under management in 2 days. So the fastest on record. And that was based on the CME futures product. So fast forward to now, as we're waiting for the spot ETFs, they also are based on CME underlying reference rates. So it's the CME CF Bitcoin reference rate or the Ether reference rate. And what those reference rates give to the market is that transparency, is that the ability to trade on a price at an index. Looking forward to that decision coming out, hopefully in the next few weeks.
Yeah, I think the entire industry also to see how the price will move and what institutions will jump into getting their hands into these ETFs. So moving to the underlying infrastructure that supports all of this, and also considering like the cryptocurrencies are known for being more volatile as well than the typical markets. So I would like to understand what is the infrastructure that supports all these products from the perspective from Blockdaemon, and also if there is any difference in terms of how do you manage the collateral and the back end of all those investments that increase this exposure sometimes, many times the investment value. So maybe starting with you, Jihane.
Yeah, of course. I mean, it's important to know that Blockdaemon is mainly institutional focused. So for us, it's really important to understand what crypto projects these institutions are actually looking into, what they want to achieve. And based on that, we would provide them with the right access nodes. We would provide them with the right RPC nodes, and basically just the underlying infrastructure to build out the project that they would want to. To take a step back regarding the regulators question that you asked, we as Blockdaemon, we are not a financial institution, but we work with a lot of financial institutions, and we're also backed by them. We're the only crypto company who's backed by 3 of the top 10 banks in the world, being Citibank, JP Morgan, and Goldman Sachs. So we also understand that it's really important to talk to regulators, to educate them on infrastructures, on the basics of infrastructure and also hear from the regulators what they expect from the financial institutions. So when we are going to support those institutions with all the crypto projects, we actually know like what is the underlying infrastructure that both the regulators as those institutions would accept. And that's also kind of what we're doing in this region. So we're looking to set up some infrastructure locally in this region because we do know that people appreciate to have like just the physical servers, the physical nodes being here, and not necessarily being in the US or in other places around the world. So yeah.
Thank you. So, in terms of managing the collateral of these operations, do you want to comment if there is any differences versus traditional derivatives or traditional operations? Luuk, yeah, or Payal, yeah.
Yes, of course there's differences. So for us, we are crypto venue. So we have around 2.5 billion in assets, which is predominantly BTC and ETH. So people deposit with us and we custodize them. So we custodize over a multitude of locations via solutions like Fireblocks, etc. Out of this 2.5 billion in assets, around 1/3, I think today it's like 36, 37% is initial margin. So let's say 800, 900 million is collateral for open positions. So the initial margin covers, we just reached an all-time high, 23 billion in notional open interest, out of which 2 billion is perpetuals and futures and 21 billion is options. And out of the options, it's around 13 billion for BTC and 8 billion for Ether options. So 13 billion in BTC options today is covered by a few hundred million in BTC collateral. The next step, which we're rolling out at the end of the year, will be cross-collateral. So we have isolated, let's say, silos at the moment. You deposit BTC for your BTC positions. You deposit ETH for your ETH positions. You deposit USDC for USDC products. At year end, we're merging all of that. So we're going to offer cross-collateral, which means you can deposit ETH to cover your BTC positions and vice versa. So collateral management and the way we custodize doesn't change, but the way we calculate margins will change. It makes overall margins more efficient. You can essentially deposit less because you don't need the double buffer in each silo. So that's a bit how we look at collateral. We're particularly known for our portfolio margin model, which is perhaps more like traditional venues and less like crypto venues. So we look at your full position, we look at your longs, your shorts, and we look at real time, we look at all scenarios. So we look at price moves of 20% up and 20% down in buckets of 4%. So what happens if the price goes up, let's say 12%, and we look at vol shocks at the same time. So what happens if volatility goes up 60% or down 40%, stuff like that. All of these scenarios are calculated real time, and the worst of all of these buckets, that's your margin. So when I say this initial margin is 800 something million, that's the outcome of all the portfolios we manage and the total. So if the market moves and the collateral requirements change, it's an instant margin call essentially. We're not relying on GCMs, on third-party clearing houses, brokers, etc. We require the client to have this margin readily available, and otherwise we liquidate them. So we're not sending out messages, please top up, and within 4 hours you need to do X, Y, Z, or 8 hours or 24 hours from now. It's instant. If the market moves, we will instantly liquidate you.
Which is the volatility of the crypto markets. If you wait for the customer to read the message and react to that,
but I think it's not only the volatility, because the volatility is the same for CME's products. The CME model and the traditional model relies on like a default fund, a pool of money, which is backed or chipped in by some very large firms. And if one fails, the other ones together essentially fix the problem. We don't have that. We are the only one managing the pool. So there's no one to help us out. We need to step in immediately. So I don't think the volatility is the key reason. The volatility is there for many products. The way we margin and the real-time setup, and I think over time that will change in traditional space as well. There's no need to wait for 8 hours or tomorrow or whatever for someone to top up. It's an instant world, and that's how we manage collateral.
Yeah, Payal, you want to add?
Yeah, so I mean, slightly, well, probably completely different model because we've taken lessons from the traditional world. And I guess in this space, what's most important? So for us, it's trust. And it's the lessons that we've learned over the last 180 years that we're now trying to apply to crypto. So on our platform, you won't see auto liquidations, you won't see a clawback, because the clearinghouse, so CME clearing, guarantees every trade. So when you come onto CME to make a trade, it is CME that acts in front of, they become the buyer to every seller and the seller to every buyer. So there isn't that counterparty risk that you may see on other exchanges. And really what that means is the ability for liquidity to grow and the ability for more clients to come to our markets. So right now we're seeing daily trading volume and open interest of, in the standard contract, about 4 billion notional dollars worth of trading every day. And if you contrast that to when we started 8 years ago, we were seeing 1,000 contracts versus 10,000 traded today. And it's really because of those checks and balances, and some of those, just to spell them out, if there is volatility, so if the market drops, we have the same stops in place that we do have in our other contracts. So we can pause the market for a split second, we can wait for that, for the trading to come back, before continuing. And what that means is the market can't fall too fast, too quickly, and push people out. So we have that central clearing model, we have those checks and balances, we have volatility logic in place, and it's to say all of that brings trust into the system, which then begs the liquidity to follow. And so it's those same checks and balances, as I say, that we apply to crypto. And also in terms of the reference rate, making sure that there is no manipulation, making sure that we have a price every day. So since we started those reference rates back in 2016, they have published every day without fail, 24/7, including bank holidays and weekends. So there is that consistency, and that consistency brings transparency, that then brings trust to the system.
That is very important, is having a proper methodology to list all those prices, and because you can find a lot of discrepancies depending on where you check, depending on the source that you take, right? So another important topic, especially related about trust and the trust of the investors, is the regulatory landscape for all these investments, right? So I think for very big names to jump the bandwagon of the crypto investments, so they probably will wait for a stronger or more solid regulatory frameworks. So I would like to ask you about your view on the current regulatory landscape around this type of investments, and also, for example, in the custody side, Jihane, how the regulators are covering this area of the business and protecting the institutional investors.
Yeah, so for Blockdaemon, we don't hold any keys. So the keys are either in self-custody with the customer, or they choose to work with another custodians. A lot of the current custodians are our customers. They use in some type of way our validators or just our infrastructure in general. So for us to partner with those custodians, for example, Comenos, Zodia are some of the custodians that we work with. Zodia got approved to start offering staking services in the UK. Comeno got approved to start staking within Vara. And they have the conversations with the regulators, but the regulators actually ask them questions. Who is your infrastructure provider? who is going to be running, managing those validators and make sure that everything is actually working correctly. So even though we don't need to be regulated because we're not a financial service provider, it's good for us to partner up with these financial institutions, go to the regulators, present ourselves, educate them on our infrastructure, be fully transparent, and yeah, just let them know who we are, what we do, that we are actually partnering with these custodians, and that the validators and other infrastructure services that they're using from us are legit, basically. So, and that's also what we're doing in this region. We currently have discussions with ADGM, also with VARA, just for them to know who we are and that we are how do you say, the infrastructure provider that these custodians choose to work with. Yeah.
Okay.
The preferred. That's
yeah.
what it is.
There is no such regulation about, for example, crypto derivatives as of yet, for example, in the UAE, right? So how do you see this evolving? How do you see the international landscape around this? Do you see many regulators all over the world working on this? Do you expect this to be heavily regulated in the near future? What is your view on all of this?
Yeah, I mean, so from our perspective, we're obviously regulated very heavily in the US, fully regulated by the CFTC. But what that means is that we can have futures and options being traded pretty much across the globe. So we have open dialogue with the regulators here. And actually, when we look at the volume that's traded, 50% of the volume that's traded on CME on crypto comes out of the US. But the other 50% is before US opening hours. And so the country of origin for some of those trades is Far East, it's Middle East, it's EMEA and UK. And when we zoom in, for this region, it's a mix of institutionals, it's a mix of hedge funds, family offices, asset managers, again, because they're comfortable with the regulation of the CFTC, and because we have that open dialogue with the local regulators that allow people to trade those futures and options. I see it changing, so there are obviously struggles within the US regulatory framework, but I think that when we look at EMEA, when we look at Middle East, it's very pro-crypto, and the regulation to date has been very consultative, meaning that a lot of dialogue was had with the industry, with the participants, with the traders that are actually using these crypto products. And so I think it's actually come a long way, and people want to be regulated. There's a big move to move out of the US, to be regulated in other jurisdictions. And so that's all beneficial for us. We will continue to be regulated by the CFTC, but we are able to operate in other jurisdictions as well.
Luuk?
Yeah, so for us, we've been unregulated up until now, approximately. We started out in 2016 and became the biggest globally, which was, and still is, I guess, fine from a client perspective. But after FTX failure, there's a need to step up in terms of regulatory framework. So that's what we're doing now. So we're building our hub here in Dubai to become fully licensed under VARA. And then the next step will be broker licenses across the world. So we directly onboard, let's say, clients from Europe under a MiFID broker. We would onboard clients from whatever, Brazil under a Brazilian licensed broker, etc. So multiple licensed brokers across the world, all routing flow to Dubai as a central hub. So in terms of crypto regulation, there's not many countries there where you can actually go because the frameworks are not completely finished. So MiCA, often talked about in Europe, is not the actual guidance is not implemented yet. Singapore MES doesn't govern derivatives, so only spot. So a lot of countries have or starting out in building proper frameworks, but the focus is typically spot, which is like a tiny byproduct for us. We need to get a license on the derivatives level, and even though you might suspect you can go wherever you like in the world, it doesn't work like that. US is hardly accessible for offshore firms like us, so you can't have one single order book by being regulated by the CFTC, because then you have to split your operations. So I think we have a quite powerful model in the making, but we're not there yet, but that's what we're becoming. But I think the key difference between us and CME and multiple other venues is these either venues, and there's plenty of startups globally that want to challenge us, is focusing on the licensing in step one. So the licensing and the trust and all of that stuff, it is very important. But I think what's even more important is liquidity, volumes, a track record, and a proper trading venue. So despite CME's, let's say, head start in terms of regulation and trust, we are, so compare BTC options on Deribit versus BTC options on CME. CME has around $1 billion approximately. We have 13 billion, 14 billion. So we are 13, 14 times bigger. Futures is really impressive what CME is doing, and they're growing rapidly. But the regulatory framework is not the only thing that matters. But I do think, as mentioned before, it's merging, those spaces are merging, the focus on those stamps. And it's not only the licensing, it's everything that comes with it. It's also the proof of reserves, which is not part of any licensing, but it's in the crypto space very important. It's ISO, it's audited financials, it's every checkbox which institutions tend to focus on, which includes licensing. Generating an overall trust is like, it's a massive difference versus 1-2 years ago, and the needs are changing rapidly. So yeah, markets are evolving.
Yeah, Payal, you want to add something?
Well, just, yeah, you guys give us a good competition in options, right? So it has to be said, your option market's number one, without a doubt. Really tight spreads, great liquidity, keeping us on our toes, right? In terms of the product offering, so for options, we initially started with monthly options. We moved to weeklies to give institutions more tools to hedge. Going into the catalysts into 2024, so obviously the ETF announcement may be around January, the Bitcoin halving in April. So institutions, similar to on Deribit, they want more access or more ways that they can hedge that risk. So we're actually increasing the number of expiries. But without a doubt, right, for options, it's Deribit. Luckily, on the futures side, we are the number one exchange for futures trading. As I mentioned, 4 billion notional traded each day. And that's larger than Binance. So it's the number one spot. But what I guess is a little bit more interesting is how long those trades stay on for. So with some of the unregulated exchanges, you might see a lot of day trading. So folks would put on a trade, happily trade there all day, maybe keep that position overnight. But for longer term trading, that's when counterparty risk comes in. And that's where you need those longer term checks and balances. And that's what we mean by open interest. So open interests are positions that are held overnight. And that's where we're currently setting new records. So over the last week, 10 days, every day has been a new open interest record, setting about 20,000 contracts traded. So day on day, new records. And that just is a testament to people coming to our markets when there is maybe volatility, when there is maybe that flight to quality, as Luuk mentioned, after FTX, when there is uncertainty, people come to a regulated market because they can enjoy those, those checks and balances.
Yeah, and I think that will only increase in the next few months because of the reasons you mentioned. So let's tackle one more important thing about this, which is security. So we see the Chainalysis financial crime report that they issue every year, that then the percentage of fraudulent transactions in all this market is decreasing. But and probably there are less scams, but of bigger value. So for institutional investors that are very worried about their money to be protected and not suffering any hack, etc., I would like to know, what are you offering to these institutional investors to give that confidence that you will not be subject of this kind of hack? So from a custody perspective, and then from a service provider perspective. So Jihane, you want to start?
Yeah, so what we believe, especially after everything happening with FTX last year, not your keys, not your coins. And that's how we came about with our wallet solution, which is based on MPC technology. It's an on-prem solution which gives the institutions the ability to manage their own wallet on-premise. And being MPC, it means that there's no single key that has ever been created. So it's all hashed keys, which makes it also a better solution to make sure that nothing fraudulent or anything can happen with signing transactions. So yeah, that's kind of what we're looking at, and we see that there's a high request for it with institutions, because they do understand that they need to outsource some stuff and work with a third party. But if it really comes to their own key management, then it's a better way and a safer way to have everything on-prem within their own environment. Yeah.
Thank you.
Yeah, you mentioned two things, Chainalysis and on-chain stuff, as well as custody. So for us, you deposit crypto, so you need an on-chain deposit, which we monitor. So we use, for example, Chainalysis, and every transaction done, either received or sent, is monitored according to something like 25 or 27 sanction lists. So every country in the world has a list of addresses that might be sanctioned. So we're monitoring against those, and every time it's updated, you can see it real time, but you also see whether you might have facilitated something 2 months ago. So it's also backward looking. So it's quite advanced. It's way more advanced than the traditional fiat system, because everything is public. So you can see it for all eternity. So it makes it transparent. In terms of custody, and that's not unique to Deribit, we have what we call proof of reserves. We show, look, these are our wallets, the full list, and you can see real time what's happening on those wallets, how many assets we have, and we show our liabilities. So all clients' assets are cut into pieces.
All real time, and you can check with an API or something?
Every day in our system, you can see, let's say you have 10 BTC in your account, you can see that those 10 BTC, they're, let's say, hashed, so we cut them in unrecognizable pieces. So let's say 10 BTC gets cut in 5 pieces of 2 BTCs to make sure you can't link any transactions. And we generate the hash after each of these items, and you can see, look, the hashes are there in the complete list. So every client can see that their assets are included in the overall list, and we publish this on a daily basis, which is called proof of reserves. So people can see that the assets are there covering your liabilities. But beyond that, what institutions need after failures of others is those assets that they deposited years ago were actually used to buy apartments or boats or whatever. So the assets were no longer there or were deployed otherwise. So instead of entrusting them to an exchange, they want to entrust them essentially to themselves, which is what we're building. I think we have like almost 7 solutions to go live. So we've integrated with Copper, with Kobo, we're beta testing Fireblocks as we speak. We've onboarded with Coinbase, we've onboarded with Fidelity, Komainu, BitGo, and Zodia most likely to be performed via copper. So you have like a range of products, and every institution. So let's say you're a US institution, you might like Fidelity. If you're a European institution, you might like copper. If you're from wherever, you might like a certain one of these names. You might be in need of a QC, a qualified custodian, from a regulatory perspective. You might want a bank-owned one like Nomura or Komainu. Whatever the arguments are, you deposit your 100 BTC with, let's say, Komainu. We can then technically and legally lock those assets without those assets leaving your wallet. So you can see that they're there. You don't have to trust us, you don't have to trust anyone else. They're in the wallet, they're technically locked, you can't do anything with it. And we only settle the P&L on a daily basis, which means that no exchange can buy apartments or whatever using their assets. The assets remain locked in the platforms. And I think that's the way forward. And many exchanges are building stuff like that.
That has third-party risk as well, right?
There's third-party risk as well, but that's your choice.
Yeah.
So you choose to trust Nomura. You choose to trust whatever entity is your choice. It's not forced upon you by us.
Okay.
It's a client choice to trust Fidelity, which they're entrusting with billions of dollars in traditional assets as well. And besides equities, treasuries, they now also entrust Fidelity with the BTC, and we lock those assets. So it's quite an advanced model.
So very quickly, Payal, because before we close, because they are
mine's very quick. Cash settled. So your cash is deposited with the Fed, segregated accounts. So really simple. And I think that's the beauty of it, that it's plug and play. If you're trading gold, if you're trading S&P, if you're trading AGS, right, it's the same thing as if you're trading crypto. I don't think we need to, like from our perspective, we don't need to treat it any differently. It fits the exact same model. So
you are using the same model all across. Yeah, so just to finish, so I would like, if possible in one sentence, ask you, what do you think still is the main barrier for institutional adoption, for massive institutional adoption of crypto and crypto investments, and how to overcome it? Yeah, so from the end, Jihane?
I think one, ease of use, and also have the right people in the right place, in the right teams to start working on those crypto projects. A lot of institutions have big ideas, want to go into tokenization, want to do a lot of stuff, but don't really know how to execute them. So, and easier access to start executing on those crypto projects, and also have the right people on the right places that can educate their team members to get those great crypto projects happening.
Thank you. Definitely more than one sentence.
Yeah, sorry.
So I'd say use case is number one. There needs to be a clear-cut advantage of using these crypto tokens, whatever that might look like. I was going to say regulation, but actually that's secondary to us. And I say that because for most institutions, they're centered around Bitcoin and Ether because there are use cases, because there is regulation. And so if we look down the chain, like, is there really a use case for those other tokens? Yeah, not yet. When that comes, there'll be regulation, and then we can do futures and options.
22,000 tokens cannot be all good, right? So, Luuk?
Yeah, so I think I fully agree with the use cases, of course. I think from an exchange perspective, it's versatility. So I don't think the forced upon model is the way of the future. If we want to win and conquer the world and embrace the large institutions, we need to do whatever they want, which means different custody, which means not only cash but also crypto, which means like choice, essentially choice.
Okay, so ease of use case for those tokens and currencies, and also versatility to accommodate the customer demand. Thank you very much, a great panel, and thank you all for attending, and hope you have a good day. Thank you.